Yeah, it's month-end rebalance.
Oh,
Right, the risk off and the elements of liquidity tightness and people needing to sell assets to realize capital is still playing out in crypto. And I think it goes further. I think we've got a 4-week window that is really scary. Something between kind of think that we need to be careful because of this month-end rebalance, right? We were told it was going to be huge. I had technical signals that said the market could bounce on a shorter-term basis, like daily stuff. My weekly stuff still says there's more downside. So I'm not sure whether this becomes the false hope or it feeds on itself. I mean, who the hell knows? But there's a massive rebalance going on, which is why it's all squeezing. It's a long weekend in the US, so everyone had to jam the order book in today. So the question is does it sell off after Memorial Day? Does it continue to go for a bit and then sell off, or was that the low? It feels that I've looked at past episodes of all of this. When the Fed are pivoting or the economy's weakening, bond yields tend to come down further before that happens because we've only just really pivoted. Sure, break-evens have come down quite a lot, but bond yields themselves have only just started. So I feel like it's too early to have the kind of celebration of the Fed are going to pivot and everything else. But I think that's all coming. We'll see inflation come down pretty sharply. Now, I also think there's massive demand destruction going on in the economy too. When I look at monetary conditions, not just using the Goldman Sachs index, but if I use the rate of change of mortgages, 2-year rates, oil, gasoline, and the dollar, that's the largest monetary tightening in all recorded history that's underway. I think we have the potential to set up to see negative inflation next year. I think the one thing that needs to happen for that to occur is for crude oil to fall. It doesn't have to fall a lot, but then the year-on-year comps by March of next year, crude oil is going to be a massive negative year-on-year. So, and that's not going against the crude oil story, which is the structural supply issue. It only has to trade lower for a period of time down to $70, $80, and before you know it, the inflation number absolutely collapses. So it feels that most of the risk assets have priced it. There are two that haven't, pretty much only two. One is oil and one is bond market. So the bond market has been following basically oil's rate of change more than it has anything else. And I can understand that because of the inflation fixation, but I think that evaporates. And we've seen a very similar setup. I've done a lot of historical analysis of these, what causes the Fed to change path. So I started with 1974. 1974 was very similar to now. We had a supply issue in oil, which was the Arab oil embargo. We had prices rise, CPI was rising, the Fed were hiking, the dollar was rallying, and then growth collapsed. And the ISM went from 56 to 30 in 4 months. That's what I'm getting in my data to suggest is possible. The next one was 84, and the Fed cut in the middle of that with inflation still up. They cut as soon as the ISM touched 50. Same in 1984, same in the 2000s, same in 2001, same in 2018. So I think the key thing is here is if the ISM comes below 50, they start to worry about the jobs mandate. In 2001, they were cutting all the way through from oil going from $100 to $140. 2018, they were cutting. They paused and had cut with the oil price coming up. Most of these examples, when you go back, even in the 1970s, inflation was still going up and oil was still going up while they were cutting. And in 1974, they were cutting from about July, and really inflation didn't roll over till early the next year. So I think it's a red herring. I think they will focus on inflation, but they realize that demand is the bigger driver. And as soon as demand starts just showing that it's coming down, i.e. the economy starts shrinking or heading that way, that's when they pivot. And that was 2018 in a nutshell. ISM touched 50 and they stopped. Bought bonds, I bought 2 years and 10 years because I don't know whether the curve steepens or flattens because it always gets a bit complicated. So 2018, it flattened first, then steepened, then went negative again, and then went up. So I don't know, but yes, I don't see any reason why not. And the bond market's kind of telling us this, that the growth is now slowing and inflation's coming off. And it's a very simple, what I love bonds is people in the bond market have one job to look at two things, growth and inflation. While in the equity market, you need to look at all sorts of stuff, including human sentiment and all of the bullshit that goes along with equities. But this is really simple. So the bond market usually gets this bit right. So it basically got rid of inflation itself by going up without the Fed actually really being involved, apart from jawboning. And my guess is it's going to start pricing out growth and inflation really fast. If you don't know how long you're going to live for, and you've got a fixed amount of capital, you tend to be careful in how much you spend. I've seen my parents go through this when they retired. Their spending went down a lot. So the consumption of that cohort goes down, but they're also saddled with debt. So that dynamic tends to create lower growth. And I look at the labor force participation rate, and you can extrapolate it going forwards. And basically it's the trend of GDP, it's the trend of inflation, it's the trend of velocity of money. It's the trend of pretty much everything of our economic lifetimes. And it's driven by this old cohort. And so that means that it's almost impossible to generate inflation for extended periods of time. You might get it from a supply issue. You might get it from, some demand issue. We had it a bit from China in the 2000s. There's a new demand source in the global economy. I don't see that right now. Sure, there's some ESG infrastructure spend that could do something a bit, but I don't really see it. The onshoring, the re-onshoring of supply chains, yes, maybe, but the flip side of that is none of those factories employ people; they employ robots. I just see the relentless rise of technology, plus this old demographic cohort that's going to take another 10, 15 years to work its way through, can only generate slower economic growth over time. And that needs the central banks to run negative real rates because of all the debt that they've done to offset it. And I haven't seen anything in the picture that's changed that. There is an argument that some put together that they're going to release their capital and spend it all, and that's inflationary. I just don't see it from the behavior of all the retirees. When I lived in a beach town in Spain, it's full of retired people, and that they start, my dad went from buying, £50 bottles of champagne to fighting in the supermarket with his friends who could find the cheapest Spanish cava. Could they find a decent one for €3? Now, that's the mindset when you have a finite pool and you don't know how long you live for. So it's really important demographics. I'm starting to err towards the balance of probabilities are for a really fast collapse in the economy. Like 1970, where it goes from 56 in the ISM, where we kind of are today, to negative something big. Now, negative 30 is pretty extreme, but the tightening of financial conditions has been so big that it's possible. Now, it's probably going to be short-lived, but I think if there's one shock out there, because people are waiting, who's going to blow up, what's going to happen? I think if there's one shock, I think it's the economy implodes, and it happens really fast. I believe that the tech adoption of AI, robotics, EV, everything is exponential in nature, and therefore you want to be involved in the secular trends. I like trading with the secular trend and not against it. And a lot of this stuff is down 75%. So I'm starting to think, this is interesting, because if inflation comes lower and rates come lower, they should perform really well. And there's some crazy valuations, stuff like Coinbase trades for nothing these days. And, it basically you need to make one decision, which is, does digital asset network adoption continue or not? And if it continues, then it's wildly underpriced, because these things are logarithmic trends. So there's a lot of stuff like that out there right now that's really interesting. Realization that growth has fallen apart, I think everything gets hit. It's that Delta One moment where every place you think you're hiding in because it's done well, like energy stocks, suddenly take it on the chin. We haven't had that moment yet. We got a little bit close, but I think there's the risk of that still. And again, it's not a certainty, but I think that's going to come. Then I actually took profits last week. I think it was last week, because just technical basis. But what I've figured that as bond yields top out, the kind of lazy trade is to say, oh, bond yields down, therefore dollar down. That is a passing correlation, right? The dollar's really Bayesian, so it kind of shifts around what affects it all the time. So I figured, okay, we might see a bit of a washout now. I think as bond yields come down, the Japanese stop buying as many bonds, and therefore it stops recycling it into the US bond market. So the dollar therefore backs off somewhat. I accidentally, 2 weeks ago on a weekend, I was searching through my library for a book to read out in the sun by the pool, and I picked up The Alchemy of Finance by George Soros. And I hadn't read that for 20 years, and I probably didn't really understand it when I first read it. And it was his trading diary of 1985, which was A, fascinating. I won't go into it, it's a longer story, but amazing. But B, it was the period over the Plaza Accord. So 1984 was actually a very similar setup to now. Very, very similar. Inflation, the Fed were hiking, blah, blah, blah. They managed to avoid the recession that time around. But the dollar backed off as soon as the Fed started cutting.
Yeah.
And then exploded higher. Yeah, it's month-end rebalance. Right, the risk off and the elements of liquidity tightness and people needing to sell assets to realize capital is still playing out in crypto. And I think it goes further. You know, I think we've got a 4-week window that is really scary. Something between 2 and 5 weeks, call it that is going to be really scary. And I think once the month-end rebalance finishes, it probably goes lower, and crypto's kind of telling us where the natural state of affairs is. You know, I think it's also interesting that bond yields, you know, keep coming down while equities kind of rallied. Normally, as equities rally, you'd be saying, well, the probability of the Fed needing to do something goes down. So yeah, I think it's written in the language of the market somewhere that risk still has to come lower first.